Okay, hi there. Welcome to lecture 4 of this course on infrastructure finance. What we will do in this lecture is we will try and continue what we have been discussing in lecture 3, that is to understand some of the basics of financial management. But before we do that, we will try and discuss the thought questions that we put forth at the end of lecture 3. We had two thought questions that we wanted to discuss at the end of lecture 3. Question number 1, can you think of some examples of companies in the infrastructure sector specifically for each of the classifications that we discussed? If you would like to refresh, we classified companies across two categories. The first category is by ownership, where we said companies could be categorized into two kinds. One is public sector companies, that is companies that are predominantly owned by the government, and the second as private sector companies which are fully owned by the private sector. The second classification that we had was to look at companies based on whether they are being listed in the stock exchanges or whether they are privately held. So if we look at classifying the companies in a matrix form, on the x axis we have classified companies based on whether they have been listed in the stock exchange, and on the y axis we classify companies based on the type of ownership. So what we have is we have a very simple 2 by 2 kind of a matrix structure, and I have given an example in each of the quadrants. At the topmost quadrant on the left hand side, we are talking about a company which is a public sector company and it is also listed in the stock exchanges. Now if you notice, all the 4 examples that I have given are essentially companies that are operating in the power sector. The first example of a company in the public sector which is also listed is National Hydropower Corporation. So this is a company that is owned by the government of India, and the shares are also listed in the stock exchanges. Next we will look at an example of a private sector company which is also listed. The example that comes to my mind is Reliance Power, and it is a private sector company but it is also listed in the stock exchanges. Now let us look at the category of unlisted companies. In the case of unlisted companies, the shares of these companies are not listed in any of the stock exchanges, they are privately held. So therefore the liquidity of these companies are not as high as we see in the case of public sector firms. In the unlisted company, in the public sector category we have Nuclear Power Corporation of India. Remember, this is also a power generating company, but this is not listed in any of the stock exchanges, but it is owned by the government. So therefore it comes under as a public sector company. The example of an unlisted company in the private sector is GMR Power Corporation. GMR Power Corporation is a small company which operates a power generating station in Tamil Nadu. This is a subsidiary of a larger company called GMR Infrastructure. Now some of you may know that GMR Infrastructure is listed in the stock exchange, but the subsidiary companies of GMR Infrastructure are not listed in the stock exchange. So in this case GMR Power Corporation Limited is not listed in the stock exchange, though the parent company is listed in the stock exchange. In fact, I would encourage you to look at many more such examples in each of the quadrants so that you get a lot more understanding on classifying companies based on ownership as well as based on whether they are listed or not. Now let us go to the second thought question. The second thought question that put forward was, what were the interesting features that you can see in the balance sheet of the corporation? To refresh, in lecture 3 we looked at financial statements and specifically the balance sheets. Financial statement consists of 3 main statements. One is a balance sheet, second is the profit and loss statement, and the third is the cash flow statement. So we started our discussion on the basics of financial management on the balance sheet, and what I had put forward as a thought question is there anything interesting that you could see in the balance sheet of the corporation? Have you been able to look at the balance sheet of NTPC, and do you have any thoughts on this? Okay, let me start with a very simple feature that you may see. If you had noticed, the liabilities or the sources of funds matches with that of assets or the uses of funds. So this is a very essential element of the balance sheet. The liabilities should match with that of the assets. If you had downloaded the annual accounts for the year 2012 of NTPC, you will find that the balance sheet size of NTPC is 140,837.8 crores. So what we mean by a balance sheet size is we are looking at the total value of the liabilities or the total value of the assets, and both of them should be equal. So that is what we call as a balance sheet size. So in any balance sheet, this is a very important feature that you should not miss. In fact, if you are able to do accounts correctly, the sources should match with that of the assets. In this lecture, we will look at several other features that we see in the balance sheet. So we will continue what we left in the lecture 3, that is the basics of financial management. In this lecture, we will try and understand some of the elements of balance sheet in a little bit more detail. Okay, this is what we saw in the balance sheet of NTPC. Just take a look for a couple of minutes. Broadly, balance sheet consists of two aspects. On the left hand side, you have what is called as your liabilities or the sources of funds, and on the right hand side you have the assets. Assets can be classified into two broad heads. First is your non-current assets. Non-current assets are essentially a long term in nature. The benefits of the assets occur over a period of many years. Current assets are fairly short term in nature, and current assets in some sense do not yield any returns. Under non-current assets, we have several categories. We have fixed assets, we have a long term and non-current investments. So the difference between a fixed asset and an investment is that a fixed asset is used, or these are investments made by the company in assets that are essential for being used in the operations of the business, whereas non-current investments are financial investments made by the company of the surplus cash that it would have, and these give returns, but these are financial returns. Essentially this could be in terms of interest on the loans that on the loan investments that the company has made, whereas fixed assets are assets that are used in running the operations of the company. If you look at fixed assets, again there are several categories. There is tangible assets and intangible assets. Tangible assets are those that are physically have a physical form. Intangible assets are those that have value but they do not have a physical form. One example of intangible assets could be intellectual property. Another example could be software. Now let us look at the sources of funds. The sources of funds for the company can be broadly classified into two categories. Now within these two categories there are several variations. As we go to the later stages of this course, we will have an opportunity to look at the variations between these two broad categories of funds. The two broad categories of funds are equity. Equity is essentially to reflect the contribution or the investment made by the owners of the firm. The owners of the firm are also known as the shareholders, they are also called as promoters, they can be called as members. In addition to getting capital from the owners, the business can also borrow capital from financial institutions, from banks and from the public. So these are called as your debt. So the sources of funds essentially consists of debt and equity. Short term debt is called as current liabilities. Current liabilities also include amounts that the business owes to other parties such as suppliers and so on. Now we will look at some additional aspects that we can see in the balance sheet. But before we even look at discussing the balance sheet further, we should look at some of the common concepts that are used in financial accounting, and it is important that we be aware of these basic concepts so that we are able to appreciate the balance sheet, the profit and loss account or the cash flow statement in lot more detail. Let me look at some of the main concepts one by one. Number one is the entity concept. What do we mean by an entity concept? In an entity concept, the firm or the corporation is regarded as a separate entity that is distinct from the owners of the firm. So the balance sheet indicates the balance sheet of the firm, it does not in any way capture the balance sheet of the owners of the firm. So in the case of NTPC, what we look at is the owners of the firm as Government of India along with other members of the public, but the balance sheet does in no way capture the financial status of the government or the other public shareholders who own shares in the firm. So it is essentially capturing the financial status of NTPC. So therefore entity, the firm is regarded as a separate entity, and this is a very important concept that you should be aware of in the balance sheet. The second concept is called as your money measurement concept. So what you actually see in the balance sheet, if you go back, there are several items that you actually see in the balance sheet. So the balance sheet, or for that matter any financial statement, is concerned only with those facts which are expressible in monetary terms. So if you are really looking at the assets can be expressed in monetary term. If you are looking at the contribution by the owners, that can be expressed in monetary terms. If you are looking at the amount of debt that the company has taken from various sources, it can be precisely expressed in monetary terms. So that is, one can clearly state the amount of borrowing that the company has done from different sources. We can clearly state the amount of investment that the shareholders have made in the company. So all of this can be expressed in monetary terms. But there are so many other factors that are associated with the firm which are not monetary based. For example, we have the number of employees. The number of employees is not a monetary concept. So therefore you do not find any information about number of employees that is working for NTPC in the balance sheet. The simple reason is it cannot be expressed in a non monetary term. The second could be the number of offices. NTPC has several offices, but they do not actually find a mention of this in the balance sheet because again it is not a monetary concept. So to understand, a corporation has several elements and the financial accounts reflect only those aspects that can be expressed in monetary terms, or whenever there are non monetary terms, the financial statements translate them to monetary terms before mentioning it in the financial statement. Concept number 3 is the stable monetary unit concept. So as we have seen, the balance sheet captures the assets and the liabilities, and it captures them in monetary concept, but we also know that the power of the monetary unit will change over a period of time. So, for example, the value of rupees 100 yesterday or an year before is not the same as what we have today. So, an year before one probably might have been able to purchase a larger basket of goods and services for 100 rupee as compared to what we can do 1 year later. So, the purchasing power of the monetary unit keeps changing with time, but the financial statements do not reflect the change in the purchasing capacity with time. So, the financial statement simply records the monetary unit and it assumes that the monetary unit is stable, that is rupee 100 5 years back is recorded as same as 500 5 years later. So, the stable monetary unit concept is used uniformly across all financial accounts. Concept number 4, a going concern concept. This again is a very powerful concept that you actually see in a balance sheet or any of the financial accounts. A firm is expected to run forever, there is no end life as far as the firm is concerned. So, business entity is expected to be existing for an indefinitely long period, and the financial statements are prepared in such a way that the business is treated as a going concern. Concept number 5 is a cost concept. The assets that are acquired by the business are generally recorded at cost. What do we mean by that? Remember, a firm, let us say in this case NTPC, acquires an asset. It could be something as simple as a computer, or it could be, let us say, purchasing of land. Let us take the second category. Let us assume the company has purchased a piece of land either to construct its office or to construct, let us say, any power generating stations. Now, when the firm has purchased an asset at a particular price, it gets reflected in the balance sheet under the category of an asset, because these are all investments that are needed for the operations of the business. A computer might be needed to support their day to day operations, land might be needed to construct power generation plants. So, therefore, all of them are captured under the assets in the balance sheet. These assets have a fairly long life. For example, if you actually own ownership of land, the benefits from those ownership is expected to accrue over a long period of time. But when you actually record the fact that the company is actually purchased certain amount of assets in the balance sheet, it is recorded at the price at which the asset was purchased. But over a period of time, the value of the asset, that is the market value of the asset, can change. So, the price of land can increase as the years go by, but in the balance sheet under normal circumstances the asset value is reflected at the same price at what it was purchased. So, this is your cost concept. Every year the value of the assets do not change, or it is not changed to reflect the current market value of the asset. Many companies periodically do such revaluations of the assets, but it is not a common occurrence. Only when there has been a substantial time that has elapsed from the time the asset was acquired, and there is a substantial difference between the value that was recorded in the balance sheet and the market value, would companies go in for revaluation exercises. So, the assets that you actually see in the balance sheet reflect the price at which the assets was purchased by the company and not the current value of the asset. So the current value of the asset could be higher or lower as compared to what we actually capture in the books of the accounts. The sixth concept is the conservatism concept. So the conservatism concept simply states that when a company is preparing its financial statements, it should be prepared in a very conservative manner. One example of conservatism is anticipate no profit, but at the same time provide for all possible losses. So this simply indicates that if a company is expecting a loss, if the company is expecting some kind of a write off, then it should be accounted for in the financial statements, though the event might not have actually occurred. So the possibility of that event happening is going to be reflected in the financial accounting, and that is considered to be a prudent management practice. Concept number 7. Okay, we will also look at an example of the conservative concept as we go along. Concept number 7 is the dual aspect concept. This is what I had actually indicated in thought question number 2, that is, the sources of funds should be equal to the uses of funds. Assets should be equal to liabilities, which consists of both equity and debt. So under all circumstances this should match, the asset should match with the liabilities of the firm. Concept number 8 is your accounting period concept. So firms prepare their statement of accounts for a particular period. So the period can actually change, but the period is mentioned for an accounting statement. So without a period being mentioned, the financial accounting statements are meaningless. For example, if you look at the balance sheet of NTPC, what we have been discussing is the balance sheet has been prepared as of 31st March 2012. So that indicates the time for which the balance sheet has been prepared. Now when we look at the profit and loss account in our subsequent lectures, we will find that profit and loss is actually prepared for a particular duration. So it could be profit for a particular year, it could be profit for a particular quarter, it could be profit for a particular month, it could be profit for 18 months and so on. But whatever it may be, unless until there is a period attached to the statement of accounts, we may not be in a position to interpret or attach any meaning. So the period concept is a very powerful and a very important concept in financial accounting. Okay, let us now continue our discussion on the balance sheet. Let us try and see how we can interpret some of the numbers that we see in the balance sheet. So I would urge you to actually look at or download the balance sheets from the internet, so that you will be able to follow the discussions that we are going to have for the rest of this lecture. Okay, my first question is, what is the value of equity or net worth of NTPC as of 31st March 2012? So equity is also known by net worth, so we can use it interchangeably. So what is the value of equity, and what does the balance sheet indicate as the value of the equity of the company? Let us see how do we find out. So if you look at the balance sheet, on the left hand side is what we have, the equity, liabilities, or the source of funds. So the expression for calculating the net worth or the equity is net worth equals share capital plus reserves and surplus. So an addition of these two items gives you the value of the net worth of the company. Now what is the share capital and what is the reserves and surplus? Share capital is nothing but a face value of the share multiplied by the number of shares that the corporation has issued. Remember, the corporation actually sells ownership by way of shares, and the total contribution in terms of share capital is found out by the total number of shares that the company has issued and multiply that by the face value of the share. Now, what is this face value of the share? Let us also look at that discussion separately. Next comes your reserves and surplus. So, reserves and surplus are nothing but the amount collected by the firm from the shareholders or accumulated over the years. Okay, let us see both these aspects in some detail. A price of a share is nothing but a face value of the share plus the share premium. That is, when a company comes out with an initial public offering, when the company sells its share to the public, it sells the share at a particular price, and this price is an addition of both the face value of the share and there is a premium. If the price of the share is above the face value, then we call it selling a share at a premium. That is, owners are willing to purchase a share at a price that is higher than the face value. If the price of a share is lesser than the face value of the share, so we are calling it as a discount. In that case, the company is giving a discount to the shareholders to purchase the share at a price that is less than the face value of the share. So, the price at which the shares are being offered in an initial public offering is both face value and share premium put together. NTPC made an initial public offering in October 2004 and it sold the shares at a price of rupees 62. Okay. Now, if you look at it, the face value of the share is rupees 10, but the price at which the share sold in the initial public offering was 62. So, therefore, if you look at it, the premium that the company has received by selling the share is rupees 52. So, the share capital reflects nothing but the face value multiplied by the number of shares that the company has issued. The premium collected during these public offerings is separately accumulated and it is shown under a reserve account. So, there are many categories of reserve accounts. One of this is the premium reserve account. So, the premium reserve account indicates the amount of premium that the company has collected when the shares were being sold at the public offering. Is this clear? There are several other accounts within reserves and surplus. Another most common account is the surplus carried over from the profit and loss account. Remember, the company actually makes profits and these profits are actually due to be paid to the shareholders. The owners of the company have technically eligible to get the profits that the company makes, but in many cases the company does not return all the profits that the company has made during a financial period, but retains some of it. So, the amount of money, the amount of profit that the company has retained over a period of years is accumulated under a surplus from a profit and loss account. So, this surpluses that have actually been retained over a period of many years is also part of the reserves and surplus. Why are these reserves and surplus shown as a part of net worth? They are shown as a part of the net worth because technically these are amounts that are paid by the shareholders, or these are amounts that the firm is due to pay to the shareholders but has not actually paid. but technically this belongs to the shareholders. So therefore the value of the net worth should capture the amounts under reserves and surplus, because that is what the shareholders or the owners have contributed to the company. Now let us look at the calculations to find out the net worth. So if you look at the net worth, it is a summation of share capital and reserves and surplus. The total net worth that we see in the balance sheet is 73,291.17 crore. Now part of it is coming by way of share capital and the remaining is coming from the reserves and surplus. The amount that comes from share capital is 8,245.46 crore and the amount that is in reserves and surplus is 65,045.71 crore. So the total net worth is 73,291.17 crore. Now let us try and distinguish between the book value and the market value of net worth. Now the figure that we just saw, 73,291.17 crore, is an amount that is indicated in the balance sheet of the firm. In essence, this is a value that the company's books of accounts indicate the value of the net worth to be. So the value of net worth that we see in the balance sheet is called as the book value of net worth. Now what is the market value of the net worth? Market value of the net worth is not given in the balance sheet, but this is something that we should be in a position to find out from the current market price of the share. Remember, we are able to calculate the market value only if the company is publicly listed. If the company is not publicly listed and if it is privately held, then we have no way of knowing what is the current market price of the share of the corporation. Now let us look at market value of NTPC. How do we calculate the market value of equity of NTPC? So the market value is nothing but current market price multiplied by the number of shares. So we would be in a position to get information on the number of shares that the company has issued from the balance sheet, and we can get the information on the current market price from the stock exchanges in which NTPC has listed its stocks. And I looked at what should be the current market price of NTPC. The current market price of NTPC was a little above 150 rupees. So for the sake of simplicity, let us assume that the current market price of NTPC is 150 rupees per share. Now the market value of equity therefore becomes current market price multiplied by the number of shares. The number of shares issued by NTPC is 824.54 crore shares. So the market value therefore becomes current market price multiplied by the number of shares, which totals 123,681 crores. Now compare this with the book value of equity. The book value of equity indicates a value of 73,291.17 crores, whereas the market value of equity is higher as compared to the book value of equity. So in many cases, or commonly, you will find there is a difference between a book value and the market value. In most cases you will find the market value of equity to be higher than the book value. If the company is doing well, if the company is financially strong, then you will normally find the market value to be higher than the book value. So whenever we are talking about the value of equity, it is very important that we recognize what value are we talking about. Is it the book value or is it the market value? If there is nothing mentioned, it is assumed that the value is the market value, and for a publicly listed company we can get the market value from the stock price in the stock exchanges, but for an unlisted company we cannot get that value. So for an unlisted company we assume the book value to be equal to that of the market value. Let us look at an example of conservatism. We talked about conservatism is a very important concept in preparing financial statements. How can we actually look at conservatism being played at in the balance sheet? Balance sheet indicates numbers that are actually available because we know the exact amount of investment that has been invested by shareholders, we know the amount of investment that the company has made in fixed assets and so on. So where does conservatism actually come in? There are several places where we can look at implementing conservatism in a balance sheet, but I will give you one example. Remember, we have something called as trade receivables in the balance sheet. In the balance sheet, under the assets column, under the current assets we have something called as trade receivables. So the trade receivables indicate the amounts that the company is expected to get from its customers for the various products or services that it has given. So the company has already supplied the goods or services to the customers, and in all likelihood the customers would have consumed or utilized those products or services. Now if for some reason, if the customer has fallen on bad times and if the customer is unable to pay the company that has actually supplied these goods and services, then the amount shown under trade receivables have to be written off. They have to be written off as amounts that are unlikely to be recovered because the customer has actually fallen on bad times. But if you are not able to recognize this non-recoverability, and if you continue to show that these are amounts that are due under trade receivables and these are amounts that are expected to be received from the customer, then we are violating the principle of conservatism, because we are not providing for the possible losses that we would like to incur in the event of the company or the customer not paying. Remember, in most cases the customers will pay, but there are many cases where the customers are unlikely to pay. So this should be clearly indicated. There are several ways in which it could be indicated. The most common form of indicating is known as an aging schedule. So an aging schedule indicates how much of the amount has not been paid for various periods of time. So the aging schedule indicates how much of the receivables are due for 3 months, how much of the receivables are due for 6 months, how much of the receivables are due for 9 months, and how much of the receivables are due for more than a year, and so on. So the aging schedule also indicates the likelihood of the customer not paying. Remember, if the customer is in a position to pay, he would have likely paid the receivables on time. If a company is having temporary financial difficulties, then there could be a delay in paying these receivables. But if the receivables has been due for a very long period of time, this indicates that the customer is having difficulties in paying for several reasons. Now a customer due for a long time is unlikely to be recovered. So, by indicating that the dues are pending for a long time, we are capturing the information in the balance sheet of potential write offs that could occur in the near term. So, writing off dues that are unlikely to be recovered and indicating the aging schedule of receivables in the balance sheet are examples of conservatism that is being implemented in a balance sheet. Now, think if there are any other ways in which conservatism can be implied in a balance sheet statement. Another discussion point is, how do we ensure the dual aspect concept is maintained throughout? That is, how do we ensure that the sources of funds matches with that of the uses of funds? How do we ensure that the liabilities matches to that of assets? Let us assume the company has actually made a profit for a particular year, and the profits are not given back to the shareholders in terms of dividends. The company retains the profits, and when the company retains the profit that is retained goes into the surplus account. Okay. So, when the surplus account increases, naturally the liability side of the balance sheet will also increase. So, how do we ensure that there is a corresponding increase in the asset side? How is that taken care of? It is taken care of in the following way. For example, if the company has actually made a profit, and if the profit is retained as cash, then the amount of cash that is indicated in the balance sheet will correspondingly increase to the extent of profit that the company has made. So, what we find is there is an increase on the liability side because of the increase in the profit surplus account, but that is matched with an increase in the cash position in the asset side. So, this would ensure that the dual aspect concept is consistent. Any increase in liabilities is matched with a corresponding increase in your assets. Now, the company could have retained the profits as cash, or the company could actually retain, or the company could have actually made some investments on this profits. So, the company could have actually bought new equipment, set up new offices and so on. So, in those cases what could have happened? In those cases, instead of an increase in the amount of cash, what could have happened is the assets shown in the balance sheet would have increased. The assets could have increased either in terms of intangible assets or tangible assets. So, again what we are seeing is there is a match between an increase in liabilities to that of increase in assets, only that the nature of assets that has increased has changed. When the level of cash increases, the increase is in the current assets, but when the company has created some assets in the profits that it has generated, the increase is under non current assets or fixed assets. Whichever way the change is, the dual aspect concept is consistent because it simply talks about an increase, it simply talks about liabilities should match with that of uses of funds. It does not really talk about how it has actually been used, whether it has been used for increasing the current assets or whether it has been used for increase in the fixed assets. Okay, we have come to the end of this lecture on balance sheet. Before we end, let me pose a couple of thought questions. Question number 1, can the size of a balance sheet change if there is a change in the accounting period? That is, if you look at the NTPC's balance sheet, the current year's balance sheet has been prepared from a balance sheet that has been prepared 1 year ago. So, the difference between the two balance sheets is 1 year. Now, my question is, will the balance sheet size change if the balance sheet has been prepared, let us say 3 months after the previous balance sheet has been prepared? Would if the size changes considerably? My second thought question is, in a balance sheet, let us say a balance sheet of an infrastructure company, what are the significant features that we see as compared to balance sheets of, let us say, an IT services company? Are we able to see some distinguishing features of companies in the infrastructure sector as compared to companies, let us say, in sectors other than infrastructure? I have given an example of an IT services company here, but you can look at companies in any other industry sector for that matter. If you are able to identify some distinguishing features that are commonly seen in infrastructure companies, it will help us to understand the other downstream aspects of financial management when we talk about it. In case you want to know more about financial statements and the line items that are there in each of the financial statements, I have a simple reading for you, which is chapter 3 of the textbook on fundamentals of financial management. This is the text that is authored by Prasanna Chandra and published by Tata McGraw-Hill. So, even those who do not have any background in finance will find this textbook easily readable. So, if you have not been able to grasp some of the concepts that we have discussed in this lecture, I would encourage you to look at chapter 3 of the text, Prasanna Chandra. Thank you, and we look forward to seeing you in the next lecture.